Jan de Witte, CEO, Mr. Anne de Sender, CFO, Mr. Karl van de Busch, IRO. For this part of this call, let me remind you that all participants will be on a listen-only mode. Afterwards, there will be a question and answer session. As a reminder, this conference call is being recorded. Sir, please go ahead.
Good morning, ladies and gentlemen. I am Karl van den Busse, Head of Investor Relations for Barco. Pleased to welcome you to this conference call, indeed on the results of the full year 2019. Today with me, our CEO, Mr. Jan de Witte, our CFO, Mrs. Anne de Sender, and both Jan and Anne will present and provide extra insights on the full year results. And we will do so following the full year 19 earnings presentation. Presentation has been made available on our investor portal on barco.com earlier this morning. And we assume you have found the deliverable in order to kindly follow the sequence of the meeting. In case you have trouble finding or downloading the presentation, please send me a short email. I think that's it for the introduction. Let's kick it off here. Jan, the floor is yours.
Thank you, Karl, for the intro, and welcome into the new year to all of you. As always, we'll give you a view on what we have in scope for 2020 later in this presentation. But let's start with a look back. We delivered once more solid profitability improvement with growth this time, and continue to make great progress in building a more efficient and competitive culture and capabilities in Barco. Okay, and then secondly, it's great to see all of this translated in numbers. That's the best and also the easiest way to tell that story. If you look at these numbers on page 3, across all of our segments and divisions, while further building up and building out our order book. EBITDA margin up 2 percentage points to 14.1. I think that's the third year in a row where we deliver a major step up. And in 2019, we also are starting to see the positive effects of operating leverage in those financials. Again, here across all divisions. And then all of this translates to a net income that ended up 27% up year over year, and free cash flow up 40% versus last year. And with that, I'm going to hand it to Anne to take us.
Or giving you some more of the same figures, I would say, in comparison with previous year, all of the KPIs scoring in the comparison on the green, you could say. Top line, both orders and sales, strong growth, ending also an order book at 300 plus, which is 6 million year over year. This order growth, strong order growth we see in all of the 3 divisions and all of the 3 regions. Sales up, excluding FX impact, 6.4%, so the currency is counting for about 3 percentage points. EBITDA up to 14.1%, so primarily this year coming from an operating leverage on this top line growth. If you look to OPEX on sales, this improved with 2 percentage points year over year. This is not after we have executed on the Fit Lead and redeployed a bigger part of this investments. Looking to the free cash flow, so landing at 89 million, up 25 million, and net income taking you in a minute a little further to that, but also there an up of 20 million. Going one further and a little more insights on the top line and this per region, you see this on slide 5 by the FX, but also excluding those very nice figures and very nice growth. Primarily, or the number 1 growth, actually, I would say both in the Americas and EMEA is cinema. If we look within entertainment to the other pillars, VNH, Where there was a more soft first half, we also there see a very nice recovery and growth back in the second semester. If we look to ClickShare or corporate here indicated, continuing on the momentum of double-digit growth, both in the two areas. And if we then look to healthcare growth, very nice uptake there. This is actually across the two business segments. On EMEA, orders and sales up 6% and 9%. If we look there per division, it's about it's a little bit the same color which we can give here or indications as were per division as were for the Americas. Asia Pacific, good for 24% of our top line. Here we year over year or in line on sales, but have a nice uptake in orders, so well boded to start 2020. China, the big up there and yielding the results from our in-country for countries on healthcare, very nice uptake in sales. On the other hand, where we saw some more softness in China was on control rooms, in particular on the second half. Corporates and our ClickShare solution, they're also getting from the ground and also building there some first nice results. APAC region, so excluding China, if you could say so, was more impacted to different countries by more economical, political slowdown with elections in the different countries, and in that sense has shown a little more softer growth. Going further to slide 6, we on EBIT at 1.5 percentage points, so depreciations and amortizations were a little higher than last year, but this actually only has to do with the impact of the new accounting standards on leasing. For the rest, no non-recurring results, neither this year, last year, so in that sense, operating results nicely flowing down to the bottom line. Effective tax rate, we could keep at the same percentage in line with previous years, 18%, and the non-controlling interest, the last indication here for the minus 1.2, you could say, is a minority interest on the result in Senionic. With that landing at a net income of 95 million, up 20 million year over year, and an earnings per share of 7.5. Sheet, so a solid free cash flow generated of 89 million. This is 8.2% on sales. Another nice uptake year over year. The gross operating cash flow landing at 140 million. So compared to our EBITDA, this is net after the payout of the restructuring, which we announced in December in 2018 and executed paid out in 2019. Net working capital controlled, it is increased compared to last year, but controlled to 3% on sales. Inventory turns a little lower than the year before. This is primarily related to the new launches of products which we did, and in that sense, some inventory buildup there to handle well the order book and timely delivers on the different orders. If you look to the average payment terms, our customers or the payment terms from our customers are shorter than the payment terms towards our suppliers, which our procurement guys could negotiate, so that's helping well out on the cash flow. With that landing on a return on capital employed of 25%, up 2 percentage points year over year. The very last figure then on the balance sheet, net cash. We call that net cash direct available, excluding the cash in Senionic, our joint venture, landing at 250 million, which is flat year over year. This is the plus, of course, in the equation is the free cash flow, but then has also paid out the dividend, of course, and did the investment in care syntax, Unilumin, 2%, which we acquired at the end of 2019. And on the KPI net cash also plays the impact of the new accounting standards on leasing. So with that,
some key messages, and I trust that later on we'll go deeper into the Q&A based on where you want to go. So we're on page 10. In 2019, we saw that beginning at the second half of 18, but definitely in 2019, the volume picked up, the big deals picked up, and then second, venues and hospitalities, and back into solid growth in the second half. From a market perspective in cinema, first, this is a market that is still further expanding, opportunities in China, India, APAC, and Latin America for new builds. Although we expect this expansion to slow down over the next years. But then, of course, what's clearly picking up is the renewal opportunity in EMEA and US. And I think you've seen us communicate last year some very exciting big strategic deals. All of them laser technology. That clearly is becoming the technology in the market. And clearly Barco with our Series 4 platform, we're confirming and affirming our technology leadership in the laser-based cinema projection. In the Pro AV and events market, it's a market where we also see that conversion towards laser that plays to Barco's strengths. We've been able to expand our Pro AV and events customer base. We're focused on capturing share with a solid product portfolio in new verticals in that Pro AV market. For example, there's a lot sharper focus on what we call themed entertainment market, museum, theme parks. Also expanding the portfolio with a new compact laser projector for the rental market as well for the fixed markets. That's the UDM platform that we started manufacturing very end of last year, and that is coming to market in the first half. Also in the simulation market, we see that market itself growing, and we see Barco extending our customer base in this project type market. All of that together led to solid double-digit growth, solid build-out of the order book, and EBITDA margin increasing to 9.5%, showing solid improvement and also reflecting the operating leverage, the scalability we have in the entertainment division. If you flip to page 11, enterprise primarily, and then control rooms progressing well on its turnaround path. In terms of the corporate, the wireless presentation market, it's still a market where we see double-digit growth, but also some signs of maturing. We as Barco continued top-line wise a solid double-digit growth track. We continue investing in go-to-market into regions where we're not as penetrated as we should. That's China, that's Japan, other countries in Asia Pacific, and I would say even in the Americas, we're not fully penetrated yet. In terms of the large video wall market, which is the broader control rooms, this is the market where the rear projection cube, the legacy technology, is further slowly declining, is also consolidating in that market, and is being replaced by LCD and LED technologies. In both cases, with the new technology investments that we've done over the past few years, we're capturing share and our position in that market well, as well in control rooms, but also outside of control rooms with a triple play, as we call it. We're one of the few players who can provide both RPC as well as LCD as well as LED. In terms of financials, in control rooms, from a P&L perspective, the P&L grew further, but also importantly moved above break-even with improved gross profit margin and reduced operating expenses. And then corporate with ClickShare continued its strong performance while we invested along the way in new category like the ClickShare conference. Page 12 on healthcare. China, the diagnostic market remains a stable traditional market, growing single digits, with of course in China an accelerated growth above the global average. In the surgical market, there the digital transformation is becoming the norm. We see competitors, but also partners starting to push this digital opportunity. As Barco, we're positioned well in both, in diagnostics and modality. We're seeing solid growth in North America, Western Europe, and very strong double digit in China. On the surgical side, with the Nexus 2.0 platform, we're able to expand and deepening our sales reach in the surgery market globally. Solid growth across the board, as I said, also with EBITDA margin further increasing to 13.5%. That's mainly driven by operating leverage on higher sales, but also a significant continued investment in growth initiative, some of the incubator new products that we have, as well as China. So I'll leave it here for the division view and 2019 highlights. Let's shift gears and take a look at 2020. That enable Barco to become more of an outcomes business. On page 14, outlook for the year. For the year, and assuming currencies remain at 19 average levels, we expect mid-plus single-digit top-line growth. At Capital Markets Day, we defined mid-plus as 5 to 8% range, with a further improvement in EBITDA margin aiming towards 15%. This outlook already takes into consideration anticipated softer demand in the China entertainment market in 2020. And that's as a result of the coronavirus outbreak. It also assumes that factory and logistics restrictions and hiccups are largely lifted and resolved by the end February, early March period, which is in process as we speak. And as always, it's a bit the case for Barco that our second half is typically stronger than the first half. I would say this year, 2020, especially with the time of the coronavirus, but also the launch of the ClickShare conference, and some effects on how partners and customers restock. We expect the full year growth to be somewhat more pronounced in the second half as compared to the first half of 2020. Give you a bit of a feel on what it means for Barco and more importantly, what are we doing about it. If you look at our people and our operations in China, we're tracking each employee since 3 weeks now. We're managing when people can get back to work. None of our employees, and there's more than 330 in China, are infected at this moment. We do have 5 of our employees that are held up in the Hubei province as a result of the province quarantine. Our factories, and we have factories in the Beijing area as well as in the Shanghai, Suzhou area. Our factories are resuming operations this week. Our factories around Beijing restarted on last Monday. Our factories in the Shanghai and Suzhou area restarted yesterday. We seem to have a 90+% show up of people, which seems to be on a comparative basis very, very positive. We have shipped in sufficient personal protective materials and supporting measures in place to also ensure that our employees can operate in a safe working environment. In terms of our supply chain, we do, like I would say, most technology companies in the world see supply interruptions and logistics interruptions out of Asia. With the current projection and the current progress we think that it's going to be normalized largely over the next 3 weeks. You have the typical stuttering and sputtering of supply chains that start up. So we're going with our suppliers through the motions of that. These delays have not affected our factories yet. But again, depending on how startups and ramp-ups go over the next 2 months, we may see some deliveries for some specific products. And we're, again, tracking that very closely, adjusting production schedules and so on accordingly. In terms of what it means for our commercial activities and the outlook, first, we do expect, and that's calculated into the outlook, but we do expect an impact on the China entertainment market investments. Whether you're a cinema or musea, theme parks, the first quarter in China is going to be a bad quarter for our customers. So those revenue losses that they suffer, we assume that it will reflect in some lower sales of projection in China. We do not expect significant impact in healthcare and enterprise segments in China. Okay, so the China hit that we're counting on is mainly an entertainment hit, not the other divisions. In terms of our international business, we do not expect material impacts for the 2020 outlook. What we do expect maybe some delayed deliveries, possibly slipping from first quarter into second quarter, maybe third quarter. Again, more delays that, as I said before, could influence this first half, second half balance a bit. Part of our objective to generate consistent dividend growth for shareholders, our board will propose to our General Assembly to increase our dividend from 2.3 to 2.65. That's a 15% increase, and is consistent with our aim to keep up a payout ratio between the 30-40% range for the dividend. And then in addition, in order to enhance accessibility to the Barco share, we also will propose to the General Assembly a 7-for-1 stock split with a target date for trading on June 1st, 2020. Two more pages to mainly recap on where we are with Barco at a strategic level. Over the past 3 years, we've laid out and followed a clear strategy. Okay, innovate for impact, focus on performance, working to offer outcome-based solutions, and going for sustainable impact. All of this with the ambition to be and remain a clear leader in our industry. And over 2019, we also added focus to embed these strategic vectors into a rejuvenated culture. Okay. If you look at this along a timeline, we've now clearly moved in what we started calling Chapter 2, where Chapter 1 over the past few years was mainly about bringing focus and performance to Barco, stepping up our competitiveness, but also our financial performance. We're now well into the start of Chapter 2, a chapter where we accelerate growth while growing in an efficient way, continuing to keep up that leverage and competitiveness, while having the leadership and financial capacity to further build out capabilities in the business, specifically then in hardware, software, and services. And as such, we're building the capabilities and prepare to be a great outcomes and solutions business in that Chapter 3, and we're then talking 23 and beyond. But that will allow us to continue delivering growth and margin accretion through a mix of hardware, software, and services. So we're well on track to execute on what we communicated at the Capital Markets Day in the month of May of last year, growing over the next years at mid-plus single digit, while further improving our EBITDA margin towards the upper end of the 14 to 17% range, where we see the 14% mainly as a bottom in case of a tough environment. And so the growth acceleration potential that's working to strengthen our regional capabilities and the empowerment of our commercial regions, while capturing the share with a strong set of new products in our portfolio, several that are being launched early in the first quarter of the year. Second, continue to expand in China. For China capabilities, we're further building out our footprint with healthcare in China, but also we'll step up our footprint and commercial R&D and manufacturing capabilities in the control rooms and the V&H area. We continue investing in what we call outcomes capabilities. This is about developing further marketing and product management skills, broadening our software and digital business capabilities, while stepping up our services excellence. Okay. And then the fourth driver, what we call locking in innovation and performance. This is about culture rejuvenation and continuing investing in the talents to prepare our organization for the future. We're also focused on improving, accelerating, leaning our innovation and incubation rhythms, while of course operating with sustainability of our products and business model in mind. And so with that, we're at the end of the prepared presentation. I'm going to hand it back to you, Carl.
Yes. Thank you, Ann and Jan. I think that was very clear, but in case there are questions, we can now move to that Q&A section. The operator will tell you how it works in a minute. Please let me remind you to our traditional householding rule of maximum 2 questions at a time. In case you have more questions, please queue again. This has shown to be the best way to get a good mix of questions and to get all the questions addressed as well. So over to the operator.
We have one first question from Mr. Guy Phipps from KBC Securities. Sir, please go ahead.
Yes, very good results. Congratulations for that. I have one question on ClickShare. You were indicating a kind of a G-curve effect after the launch of the conference and product. Can you elaborate a little bit on that? And do you already see some indications on that after the launch last week? Thank you.
You said G-curve, which
slower growth in.
Okay. I would call it freezing of the market.
Okay. Yeah.
So we, the past 2 weeks and definitely this week at IZ, we're announcing this ClickShare conference. ClickShare conference, which we do position as a different category. This is about conferencing, not just wireless presentation. It does, however, have a wireless presentation capability. You're not going to have in the same room a ClickShare conference and a ClickShare wireless presentation. And so the fact that the ClickShare conference also includes wireless presentation functionality, we expect will create questions with customers. Shall I just invest in wireless presentation, or with the meeting room I have, do I invest in ClickShare conference? Do I invest in more video or soundbar equipment? And it's that customers making up their mind that we expect in the first quarter may lead to some longer decision times at customers. In terms of have we seen that yet? Not yet. We've definitely seen some very good pre-orders on conference, but it's a bit early to really assess in how far are we freezing the market.
And the second question is on the replacement cycle in ClickShare. When can we expect there the first replacement units to come available for you? Hello?
Ladies and gentlemen, hold on 2 seconds. The conference will restart shortly.
Hello?
Hello? Did you hang up?
No, we did.
You hang up.
No. They were talking and suddenly I didn't hear you talking, so something happened.
Can you please open up again?
Yes, I put you back.
Yeah.
Yeah.
Are we back in?
Hello?
Just 2 seconds.
Yeah. Hello? Guy, you hear us?
Yes, thank you.
Yes, Guy.
Okay, Guy.
We had a technical problem.
It's not clear what happened.
Let's go.
Where
did you get the question or the answer?
Nothing at all, to be honest.
Okay.
So for the second question, the first question was okay.
Okay. So you heard me until the
replacement,
end? Okay.
of the first question, yes.
Okay.
So open for your second question then, Guy.
Yeah. And that was on the replacement. Do you already see some replacement units for ClickShare, and when do you expect that to kick in? Thank you.
Yeah. It's a fair question. I mean, we are 7 years in the market with ClickShare, and we do have a trade-in program available on ClickShare. But it's also fair to say that the number of units coming back is per today quite limited. So we have the program in place, but to see more material volumes, it's probably going to take a year or two to really start seeing that kicking in.
Yeah, it's also going to require, Guy, us to trigger the channel to go after replacement, while at the same time going after ClickShare conference.
Yeah. Okay, we can move.
Okay, Elke again.
Yeah.
Okay. We have another question from Chris Keppers from Kepler Cheuvreux. Sir, please go ahead.
Hi. Could you break down guidance per division? And second question, can you give a bit more color on working capital movements? Thanks.
Good morning, Chris. I'll take that one. So on the guidance on the group level, repeating, so mid-plus single-digit growth for the year, and then with an EBITDA increase up to 1 percentage point. So going after or towards climbing up towards the 15%. On a divisional level, on top line, actually, on all of the three divisions, we give the same guidance, or mid-plus single digits. If there would be a kind of order of biggest to lower, so to speak, biggest growth we expect in entertainment, and then followed by enterprise and followed by healthcare, but all of the three in the mid-plus single digit range. If we look to the EBITDA margin, so where we landed for the group, 14%, and now guiding towards 15% for next year. On the divisional level, entertainment, we see there a further uptake in EBITDA margin coming from a top line and operating leverage effect. Into enterprise and healthcare, we expect the EBITDA to land in the range of or more close to the margin of this year. Both were already at a higher margin, and there we continually step up into investment into particular growth initiatives, and that's why we invest kind of the extra EBITDA margin coming from the top line increases in this particular domain. I hope this answers your question.
Yes, fine. And maybe the second question, could you maybe give a bit more color on working capital movements?
Working capital, so we landed at 3% of sales, net working capital for this year, and I would say more stay in that range, or from 3 to 5% maximum working capital. So we do on particular bigger contracts allow some longer payment terms. So that's one. But on inventories, actually, should keep up and even do better on the terms there. So take a range, I would say 3 to 5% maximum net working capital on sales.
And perhaps in addition, on the movement on 2019 compared to 2018.
Yep.
We landed at 3% coming from net, a whole percentage points actually. And the year before, the increase was primarily coming from the additional inventories linked to new launches of products, and then with some transfers of production from between factories. Actually, we also had some higher inventories primarily in the second half. But as we continue to uptake in our sales, actually have different new launches, new products, certainly control this working capital and inventory terms likewise, but we will expect some further increase in inventory.
Yeah, okay, thank you, Anne. Open for the next question.
Yes, next question is from Mr. Marc Hesselink from ING. Sir, please go ahead.
Yes, thanks for taking the question. First question is actually on entertainment, and then I think more digital cinema, because order intake in the year was, I would say, very, very strong. What are you seeing? And I still you stress in the press release that it still excludes the big framework contract. So could you talk a bit more on the momentum, what kind of growth digital cinema can do in 2020, and how it will ramp up after that? And my second question is, you obviously have now two big new product launches. So first the digital cinema, the Series 4, and in ClickShare now the conference. You in the past you said that you've been working on also on all product categories and all you're working on new platforms and trying to improve stuff. Is that something that's also going to happen in the near term, or is that more like a longer term upgrade cycle of your current products? Thank you.
Okay. So, Mark, on the first question and some color on the good order intake in entertainment. So that is coming from, by the way, both cinema, definitely the strongest contributor here, but also the venue and hospitality space registered a good uptake in orders. More specifically on cinema, indeed, we make that note that we're not including those huge master frame agreements that we have signed up with, for instance, Cineworld, with IMAX, with Cinemark. But we only book in order intake as well as in order book the call-off orders. So typically the orders that are submitted for the next coming quarter, max for the next coming 2 quarters. So to that extent, we're not inflating the order intake numbers with those frame agreements. So we believe that the nice order intake number gives a bit of feeling with the good evolution and the good prospects that we see here in cinema and in the entertainment division as a whole.
So, sorry, can I quickly ask a little bit of clarification there? So does that imply that what you're seeing today is in line with what you earlier expected, or is the adoption quicker than you earlier expected?
It is in line with our expectations. We already in 2018 we said that 2019 was expected to kind of mark the beginning of the real replacement wave in volume, and I think with the results of 19 in hand now, we can show the impact of that replacement wave now, both in sales as well as in order intake. So yeah, it's in line with what we had in mind. Yeah. So over perhaps then to the second question, and Jan will take that.
Yeah. So I, Mark, I understand the question on what's in terms of new product introduction. Where are we? You're right. We have a significant focus on ensuring that across our different business segments, we have a steady stream of new products. I think the ClickShare conference has been very visible. I think the Series 4 in its launch 9 months ago. The next one coming in the Series 2 is what we call the B series. That's a higher lumen version of that. But then if you go within entertainment to the venues and hospitalities, we're bringing to market the UDM, which is in the same family as the UDX. It's a laser projector for venues and hospitalities, both in rental and the fixed market. We're also bringing out new image processing propositions for the venues and hospitalities market in our enterprise business. Again, you have the ClickShare conference, but if you then look at the control room activity, we're bringing to market a first and new LED offering for the control room market. We launched a month ago the UNICE 500, which is a lower mid price point for the UNICE. And we brought out every quarter upgrades of our Upspace software, workflow software for control rooms. And then in health care, at RSNA last December, we launched a broad series of new products for our diagnostic area. A new Coronis 4MP and 6MP, a specific offering for remote displays, when the radiologists want to work from home, give them Barco quality at a different price point. The QA Web connected quality management software, and then an upgrade of the Coronis Unity and the Neo Color. I know it's a long list, but what I'm trying to convey is that across the business we now have a steady stream of, at the minimum, annually, depending on the big fairs, in some cases quarterly, where we have a product portfolio that keeps evolving and keeps us giving the opportunities to enter different verticals within a market or even different categories.
Okay, so if I understand that correctly, then so yes, we had a big year of new product introductions, but looking forward, that's not going to be exceptional. That's going to be the new trend.
Yeah, if I compare to, let's say, I feel very good with December, January, with all the new stuff that we're bringing to market, right? That's also when I'm standing in front of our salespeople. That's what gets salespeople excited. It's definitely a step up, at least in my history, versus what's our normal rate. And I would consider that going forward, that becomes the normal rate of renewal and intensity of staying ahead of competition.
That's clear. Thank you.
Yeah, over to the
Thank you, sir. Yes, sorry. Thank you, sir. Next question is Mr. Stéphane Judou from Degroof Petercam. Sir, please go ahead.
Yes, thank you. Good morning. First question, you mentioned on the margin evolution for this year for enterprise, but about similar margin compared to last year. Control rooms is roughly break even, slightly positive. I would expect in control rooms margin improvement this year on the new product software solutions rollout. Does this imply that for the ClickShare you model in some margin pressure for this year, or do we really need to move to these outcome-based solutions also in control rooms to get the margin up there, not this year, but perhaps in 2 or 3 years? And then second question on healthcare. Could you elaborate a bit on the strategy implementation of healthcare in China, how you're approaching the market, how you are selling the products, distributor networks, etc. Thank you.
Okay, Stefan. Anne will take the first part or the first question. Yeah.
If I summarize a little bit your first question, then it's in particular on how do we see the evolution in 2020 of the EBITDA margin of enterprise, and how do you split that out in control rooms being at break even this year, and then corporate. On control rooms, indeed, happy after a couple of years of intense work, we finally at above EBITDA break-even point there. For 2015, yes, we want to increase that, but that's not yet, so that's, call it, not yet towards the 10%, more to the 5% EBITDA margin actually. So to do a further uptake there and also towards more average levels of Barco margins actually, we need to have more nominal outspoken, more material nominal amounts on software related sales. Where we do work on and have some newer launches in the second half 2019, which is really a true beginning of that, but it will take some more time to really reflect that materially into the figures. And as to corporate, I would not call it really price pressure. It's really a conscious decision to reinvest also in new incubators and learning experience. Our WeConnect offering there, and the market penetration is just one example there. So it's it's a decision to reinvest in particular growth initiatives, and with that altogether actually that's why we land at the guidance of an EBITDA margin staying in the area of 20 to 21% for enterprise, which we already have in 19.
Yeah. Okay. Jan, you take the second question.
Yeah. So healthcare in China, you have to consider two types of markets. The first market is the modality market. This is where Barco sells into the big medtech OEMs, the big and the less big. We're talking here the traditional Siemens, Philips, GEs, but also the big United Imaging, big Chinese company. And then in the Suzhou area, there's another 100 other players. That's also the reason why we set up shop in the Suzhou area. And then parallel to that, you have the diagnostic imaging sell into primarily hospitals. That is a market primarily going over a distributor network, where we as Barco also have people in different sales offices to manage distributors, to create preference with the hospitals. But the diagnostic is a distributor sale. The modality sale is a direct sale, but to medtech OEMs.
Okay. And in terms of operating room possibilities in the Chinese market?
Yeah, it's a good one. Operating room, again, two ways of selling. In China, the strongest channel is the one going through OR integrators. These are integrators that take on a operating room new build or a refurbishment project. So we work through them with our Nexus technology. We're also, with some of the medtechs, building in our Nexus technology into their medical devices, endoscopics, robotics. And that's a second or a secondary path to market in China, which I would say is with the upside down if I compare that to Americas. In the Americas, the primary route to market for Nexus is the design in with endoscopic players. Secondary is through system integrators.
Okay, thank you.
Thank you, sir. Next question is from Mr. Christophe Beguin from Kempen. Sir, please go ahead.
Good morning, all. I have two questions from my side. First of all, we saw last week partnership announcement with Logitech. I was wondering, can we see further partnership announcement? Do you have some other in the pipeline? Are you working towards there in terms of rapidly speeding up ClickShare conference? That's my first question.
Okay. Thank you, Christophe. So on partnerships, first of all, ClickShare conference, we're gonna use our conventional partners as we have them for ClickShare Present. So the distributors and the established channels that we have will be reused, of course, to push also ClickShare conference towards end users and corporate. But in addition, we believe that ClickShare conference is indeed the perfect product to sell as a kind of package together with video peripherals, speaker peripherals. And so that's an area where Logitech has a great deal of the market, and so it is for us quite a nice collaboration agreement with Logitech. So yes, it's not, by the way, it's not exclusive on both sides, and we are further looking into expanding those kind of partnership into the market. Jan, you have an addition?
Yeah, maybe one addition on with relation to China, because like Carl said, why Logitech? Well, Logitech is the big mammoth in that type of peripherals. They're also strong in China. However, in China we are also looking at the China equivalent of the Logitech type players, as a bundled way of going to market.
Okay, thank you. And last question was, like many other companies having operations in China, you also point out potential delay or impact from Corona, but I was wondering how good is the visibility that by the end of February supply or operations will be back at normalized level?
Yeah. So we're tracking on a daily basis with our supplier factories. Okay, so like we track our own factories on when and how they're starting up, what's the show-up rate of people at the factory, and so we see all of our suppliers this week getting back in action. Some are at 70%. People show up. As I said, for Barco we're at 90. So for some reason we're better off, or we're managing better. But there's a close management of where they go, and then second, close management of the transportation, right? And I would say today I see transportation as the bigger area of stuttering, because there is some capacity that has disappeared from the market with some of the commercial flights going down. So we're working together with our logistics companies for alternative routes and so on. And every day we find new solutions, but it's going to be a process of 2-3 weeks of realigning logistics in the supply chain. In itself, that's not a rocket science. That's just daily hard work and agile work.
And a bit of recovery as well. Yeah.
Okay, thank you.
Thank you, sir. We have another question from Mr. Trian Reid from Berenberg. Sir, please go ahead.
Yes, thanks. Good morning, guys. Two questions from me as well. Firstly, just on the gross margin, we saw that was down 260 basis points, and I think we probably expected that to be up, and you obviously called out these quality issues related to product ramp-ups and factory transfers. I just wondered if you could give more details there, whether those issues have been solved and what it implies for the gross margin next year, because obviously that 9 million down in EBITDA that you mentioned in the bridge, that could have meant your EBITDA margin being significantly higher than it actually was. And then my second question is just on the COVID-19 virus. You obviously included your expected impact in the guidance, but if we exclude that, what would the guidance have been if it didn't exist? Thanks.
Okay, we'll start with the gross margin question. Jan, you'll take that?
Yeah, I'll take that because it's a bit of an operational answer. So first, we did expect in the year some pressure on gross margin, mainly from we said mix and price. I think it turned out it was less mix and price, but it was I would say material impact from cost of quality. What happened, and this is linked to the factory here in Kortrijk. Last year, and specifically in the second half, we had a very significant ramp up of activity linked to the Series 4 cinema projection. At the same time, we were doing the last transfers of product lines from Fredrikstad into this factory. And at the same time, we were also preparing for the launch of the UDM projector, which is now in the market. And on top of all of that, we saw volumes in units increase more than double digits. So we definitely put the factory here under pressure, which results in new people on board that are also have to go through the learning curve, goes through supply chain that needs to ramp up, and also, as often happens, ends up in a lower yields, lower first pass yields, and investment in rework. What I describe here is the months of I would say August till November. We're pretty much over that hump at this point in time. So we do not expect that to be a factor in 2020.
Okay, good. So should we think that you should get that 9 million plus back in 2020? i.e. your gross margin can go back to more like the 40% plus it was in the past?
We more expect for the 2020 to be gross margins more in line with the full year 2019. So in that sense, a little bit more cautious there, and I'm not really thinking that will be the major up. That's also the guidance actually, or in line with the guidance we gave at the Capital Markets Day. If we look longer out towards 2022. So in that sense, and that might then be some price pressure or some, call it, volume discounts linked to bigger contracts, some product mix effects that we might have. We are not counting that this will come again from cost of quality, and on the cost of quality and overall yield improvement, that for sure we want to get back at better levels than it was in second half of 2019. So that's for sure.
Okay.
But the EBITDA margin uptake in the next year and years will primarily come from operating leverage on top line growth. That's actually short term.
And then Jan, on the second question of Trion on what would the outlook have been without a coronavirus outbreak?
Yeah, I think if we would not have corona, and essentially it's the impact on the cinema market or the entertainment market in China. In that case, I think we definitely would have felt strong on the high end of that mid plus, say the 8-9% type growth. Okay. Yeah.
Okay, brilliant. Thank you.
Thank you, sir. Next question is from Mr. Sébastien Lemonnier from Inocap Gestion. Sir, please go ahead.
Hi, good morning, and congrats for result again. Just quick question on the medical business. Can you update on the potential ramp up and acceleration from 2020 or after? I'm more thinking about all the partnerships you've been signing with different players in the industry that should probably help you to penetrate or to accelerate your penetration within the surgical business. I'm thinking about Demetra, especially since the FDA approval. What kind of expectations can we get for H2? And the last one is, I'm surprised there was no question this time on M&A. Can you consider something within the medical business? Because it's probably overlooked, but it's probably one of the most promising to me, and I'm just wondering what the long-term strategy if you aim to make this business more medtech business than it was today.
Yeah. Good morning, Sébastien, and thank you for the questions. So yeah, healthcare and surgical. You're right to point at a number of partnerships and expanding the partnerships we have in this segment. So actually, we remain positive to very positive on surgical. Continues to be a growth engine in the healthcare division. Good growth engine in 2019 and expected to remain one of the strongest growth drivers for 2020 and beyond. And actually making further inroads with a number of partners, getting more of their business and being built into their technology. So yeah, we remain really positive on that part of the business in healthcare. And so in the mix of surgical plus diagnostics and modality, that's also where we then end up to a mid plus growth figure going forward into 2020. Jan, a couple of words on Demetra perhaps?
Yeah. So, I mean, a tough question, Sébastien. I mean, the reason why we're in Demetra is first because we believe it's accessible market of 100 million or more. If not, we probably would not invest in it. That's a little bit the threshold when we look at incubators, to really go for them. Now, how exactly that market is going to play out very much depends on is this going to be a technology only for the dermatologist, the specialist, or can it also become a tool that general practitioners will have in their practice? I mean, clearly, we're trying to make it a tool also for the general practitioners. That's where the quality artificial intelligence aspect comes in play. And that's where 2020 we're investing into two important elements. One is building out our go-to-market with significant focus on the Americas, because that is a big market. And at the same time, we're now bringing out on a quarterly basis AI capabilities, some that also will go through an FDA certification, which is important to make it accessible to a wider GP population. Okay. Again, it's a bit of a long answer. Like any incubator, we definitely have high ambitions, but I think the next 2 years the data points will show what type of curve we'll be able to build.
And then Jan, on his last question. M&A.
Yeah, M&A and then specific healthcare. The answer is yes. Right. I think you're right. The medtech area is a broad area. Many different companies. We are like in other divisions. We're looking at different complementary either technology or volume acquisitions. And that's part of our let's say normal process of looking now. I'm going to add what I continue to add. We're going to be rational and restrained in M&A. We're not going to jump to anything too quickly. But we're definitely looking, and yes, medtech is an interesting area for us.
Thank you very much.
Thank you, sir. We have another question from Mr. Graham Reed for Berenberg. Sir, please go ahead.
Yes, sorry to come back. Just on the guidance, you said 8 to 9% without coronavirus. Would it have had any impact on the margin outlook?
I'm taking this question.
The short answer is no, actually, in the sense that going towards the 15%, climbing up from the 14 for today, that's the range where we really want to go for. So no, not material other impact.
No.
Brilliant. Okay, thank you. And then just a second question, just on ClickShare conference. I was lucky enough to see it yesterday at ISE, and one of the things that strikes me is that the pricing is quite a bit higher than the standalone ClickShare, and obviously you expense your development costs, and I'm guessing the hardware impact in a conferencing unit is fairly low. So I would have thought that the margin on the conference product would be quite a bit higher than on the standalone. Obviously, we have to make our assumptions on what proportion of your units would be with the conference versus without. But are you being sort of overly conservative when you talk about corporate margins, enterprise margins being flat, given this and also control rooms should have a better margin?
Well, I'll kick it off first, and then Jan, feel free to add on. So first of all, ClickShare Conference indeed comes in at a slightly higher price level compared to ClickShare Present. Now, for the year 2020, take into account we only start shipping by the end of the first quarter. So we are indeed for today more on the cautious side in projecting the volumes that we will ship over the next couple of months. So we will get smarter in the next coming months how the growth curve on ClickShare Conference will develop. And then on the margin profile for ClickShare, you need to add to that.
Well, it comes back to the question earlier asked by Stefan on enterprise actually. So within enterprise, where we guide for a flattish margin or a margin in the range of 20 to 21, which it was also in 2019. The extra margin which we make in control and also which we expect on ClickShare actually, we reinvest in growth initiatives. And I think one actually is the market acceleration or the go-to-market investment for a reconnect. And meanwhile working steadily on the roadmap. If you heard all the long list of that Jan indicated of new products which we on our roadmap consistently work on and bring out, launch, we want to keep ahead in this leadership on technology, and that's why we also continue to invest 11% R&D for instance, but also making sure that also on our go-to-market investments we keep on investing and there to the tune of 13% on sales and marketing costs on sales. So it's all that combined. So call it overly conscious, I would say not. You do know that we are ambitious, but at the same time keep our feet on the ground always. And as we get smarter during the years, for sure we will do more fine-tuned guidance as soon as we can.
Perfect, that's very clear. Thank you, guys.
Thank you. We have another question from Mr. Christophe Vegan from Kempen. Sir, please go ahead.
One last question from my side is, are there still thoughts on building production facilities or just as you did with the healthcare division that you bought, that you have built a production facility in China? And so how should we look then for 2020 in terms of R&D expenses in terms related to sales and CapEx? Thank you.
I see that Jan is eager to take your question.
Okay, it's a short answer. The answer is yes. Right. I indicated within the venues and hospitalities projection part, there's quite a lot more opportunity in China. Same logic. We need to innovate R&D for China and have the agility. So yes, we're looking to build. In terms of capex expenses, that's not dramatically going to change the typical rhythm annual capex that we build out. So that's frankly over the past couple of years we've every year built or rebuilt factories, added automated warehouses. So we're on a good rhythm of building infrastructure, which for the next couple of years we're going to continue doing.
To be more complete on the capex guidance, actually, there's for the year to come between 20-25 million, which is in the range of the previous years.
Okay, thank you.
Thank you, sir. We have no other questions. Ladies and gentlemen, I would like to remind you that if you wish to ask a question, you may press 01 on your telephone keypad. We have no other questions, sir.
Okay. Well, I think we can conclude this analyst call and the Q&A session. Just one more thing. Perhaps some of you already noticed that we also released our 2019 annual report this morning. So the company report, a full sustainability report as well, and the financial statement. Also available on our investor portal. I would say a happy reading, if it's not today, over the weekend or even later. Let me thank you all for participating in this call. Thank you, Anne and Jan, as well, for the useful insights. And should you have any more questions coming up, you can, of course, always reach out to me. Thank you and have a great day. Bye-bye.
Ladies and gentlemen, this concludes